The subsidiaries contribute significantly to the group. I know Kenya still contributed 89.3%, but that's because Kenya probably grew significantly faster than the subsidiaries, because year on year, the subs have contributed over 72%, or they have grown over 72%. But as a business, I think we've continued to grow. Our loan book has continued to grow. You saw that we grew by 6% in percentage terms, but in absolute terms, it's about 12 billion, which is quite significant. But also, we've also focused on government securities. I think our yield on government securities is an average of 12.3%. So rather than having cash just lying idle, we want to have the minimum reserve that the central bank requires. And any excess cash, if it cannot be lent to customers, then it is invested in other securities.
On the back of what you just mentioned on the subsidiaries, you mentioned that they contributed about 72% in terms of growth. But if you are to take a deeper look at the profitability, if you look at Uganda, it just contributed about 1.1% in terms of profitability. Yet this is one of the first markets that KCB penetrated in terms of its expansion. And South Sudan, which is one of the most recent ones, did about 9.2%. Tanzania, on the other hand, about 0.01%. Maybe you can give us an indication what happened in terms of profitability if you're looking at it now from a point of your subsidiaries.
At the moment, South Sudan remains our second most profitable subsidiary after Kenya, and it contributed 9.2% to the Kenyan, to the group performance. Now, South Sudan as a market, we know it's a virgin market. We were the first, probably international bank to go into South Sudan. We are the largest bank in South Sudan. We are in every state. We have 21 branches. The market at the moment in South Sudan is not stable in terms of lending, but I think it's growing there, it's getting there. This year, our loan book has grown 100% in South Sudan. But I think the key revenue has been from commission, foreign exchange, other fees, and basically non-funded income, as opposed to interest income. Now, Uganda, on the other hand, is a market whereby you have, I don't know the number of banks there, so let me not guess, but there are quite a number of financial institutions as compared to South Sudan. But our market share is improving significantly, and we hope that, in a few years, we'll be able to perform as we are doing in South Sudan. Now, Tanzania, on the other hand, is a very tough market. The culture there is very different from the Kenyan culture. Lending is not as easy as it is in Kenya, but we're doing our best. So I know we've reported a loss this quarter, or this first half, but at the end of first quarter, we reported a profit. There was a fraud in the second quarter, which is fully insured, and we will recover from the insurance.
In the first half period, we saw your non-performing loan ratio growing to 8.3% from 6.3% year on year. What led to this growth, and in the second half, are you likely to increase your provisions for the non-performing loans?
As a business, we know it's a worrying number, and we are working extremely hard. We are following up on all those debts. We have quite a number of customers who are suppliers to the government as well, and due to the transition between, just before the elections, there were delay in payments as the government was settling down. I think those are now coming through. There's also a new prudential guideline that clearly states that once a loan moves to NPL, it cannot reverse back until after 6 months, even if it starts performing immediately. So we will see the reversal actually in Q4, because we have to spend at least 6 months.
Looking at your split in terms of business and deposits, we saw from the presentation that the corporate business does about 53% in terms of deposits. Looking now at something like personal loans, it just does about 2%, and the SME also does substantially low. Is there a strategy to actually change from corporate to retail going forward in terms of deposits?
Actually, not just in terms of deposits, it's also in terms of our asset side of the book, which is the loans and advances. Now, we know that we've been heavy in corporate, and we know that the margins in corporate are not as significant as the margins in retail. And if you look at our net interest margin, which is the NIMs, we are 10.7%. Now, other banks, some of our competitors have reported 13%, and others have reported between 10 and 13%. Now, we want to be in that space. We want to report higher NIMs. So how do we do that? I think it's for us to consider repositioning our balance sheet. And what I mean is that accelerate our retail business without cannibalizing our corporate business. So we still have a corporate team. You'll see our corporate business still grow as it is, but I think the acceleration will mainly be on the retail side of the business. So the corporate side, from a percentage perspective, may actually reduce to probably 40 or even 30%, but that reduction is because of the acceleration of the retail business, as opposed to actually cannibalizing the corporate side of the book.
During the presentation, it was mentioned that the bank is looking to retire some of the expensive corporate accounts. Maybe you can give us an indication in terms of how this will look for the bank, and also going forward, some of the other sources of funds that you're likely to look for that will be more cheaper for the bank.
Yeah, it's not retiring the corporate account, it's retiring the most expensive fixed deposit accounts. So what happened was, if you remember in 2011, 2012, there was tight liquidity in the economy. And as a result of that, banks were tight on liquidity, so banks went out borrowing. So you had wholesale companies, I'm not going to name names, who then walk into banks and say, I have 5 billion, for example. I want an interest of 20%. So they actually became bankers, because if you try to lend them, they would say, please lend to me at 10%, but take my deposit at 20%. Now, because banks were tight on liquidity, some banks actually did that. And as a result of that, some of these deposits were locked for a period of 1 year in terms of fixed deposits, so that the banks can be able to then lend and just manage their liquidity. So what we are saying now is that liquidity has eased in the market, so it's now flexible, and therefore there's no need for us to carry these expensive deposits. So it's a deliberate action by management to actually retire these deposits and try and focus on cheap deposits. We're also talking to a few DFIs to try and get cheap borrowings from them, so the likes of IFC, the likes of KFW, the likes of European Investment Bank, China Development Bank. So we're in discussions with all these DFIs, and if everything goes well, then we'll focus on collecting cheap deposits from those in terms of borrowing, rather than focusing on very expensive fixed deposits from corporates in